Hi, this is Sean Casey from Trade Canary, and in this video I'm going to show you how to buy a call option on Charles Schwab. First thing you need to do is sign into your Charles Schwab account because you can't buy anything until you're in the account. And once you are, you're going to go to the very top menu up here. You're going to click on Trade, and you'll see there are some different choices. Click on Options, and it will pop open this window for you. You probably saw that it flashed there that streaming data was not available. That's because the market's not currently open. Once we're in here, this drop-down menu would actually give us the choice to switch to a put or buy something else if we wanted to, some complicated option strategies, but let's just stick to call options right here. And then over here, I can pick the stock that I want to buy an option on. And let's just say that I type in the symbol for Intel. You can see it'll start dropping down a menu once I put in some of these letters. And then I type in INTC and I can click on Intel and I know that I have the right stock. When I do that, it will show me the current data on Intel, the last traded price, when the market closed, the range, all the information on the stock itself. And then I'm going to click over here to buy. In this case, I'm going to buy to open. That's a position that I'm going to have where I'm just buying it outright. And you'll see that it's green, so it shows me that I'm buying, and I'm going to do that in a minute. Or I can buy to close. That means that I already own the option, and I've sold the option previously, which I could do. I could sell an option on a stock, and then I could buy it back. Basically, if I sell a call option, I'm believing that the stock price is going to fall. And I could sell this option, for example, for 92 cents, and that I can buy it back for 50 cents later in the week, or maybe it'll expire without me having to even pay for it. That's a trading opportunity that I would have. I could also sell to open. This is where I'm selling the option myself, and someone could then sell me the stock at the specific, in this case, $23.50 price, because I've sold the call and I'm willing to fill that option. In this case, normally, other than if you have an advanced trading account, you'd have to own the stock in order to sell the call, but it's a great way that you could generate income. If you thought, hey, listen, I could sell this call and now I could buy the stock for $23.61, I could sell the call for 92 cents at least, right? Probably 95 in the middle of the spread, and make 60, 70 cents on that stock in this week if the option gets called away. If I don't get called, if it closes below $23.50, then I would get all that premium for free. I know there's a lot of options here, but you need to just have your mind expanded a bit as to what you can do. And the other thing is you could sell to close, which means I already own the option and I'm going to sell it to close my position. So I'm either opening or closing a position when I start trading an option. In this case, I'm going to buy to open a position because I'm just buying the call option. It means my total exposure is what I'm paying for the option. You can see that the ask price is 99 cents. I have one option that represents one contract of 100 shares, and therefore the estimated amount I would pay is $99 because it's just showing my price at 99 cents down here. We can adjust that in a minute. But just so you realize, when you see the 99 cents, it's really, you got to multiply that by 100 because you're controlling 100 shares of Intel. But your only risk in buying a call option is the $99 that you pay out of pocket. If you bought the stock, your risk is that the stock drops to zero, which unlikely with Intel, and I'm not saying that it would, but with an option, my risk is solely that I invested $99, and the worst thing that happens is the $99 goes away, not my 100 shares of Intel. Okay. Obviously, we're buying Intel. Okay, so we can't change that symbol. That would change up here. And then we have to decide two other things. Okay, obviously you could change it from a call to a put, but what we need to decide is how long until the expiration of the option do we want to own the option? The sooner the expiration, the less expensive the price is because there's not a lot of time for this to gyrate, right? But in many cases, you'll have stocks, especially high volume stocks like Intel, where you can trade these options in the near term for 1 week expirations. In this case, I could trade this where it's going to close in 5 trading days from now, next Friday, or 2 weeks from now, or 3 weeks, or 4 weeks, or 5 weeks. But I could also go all the way out 23 months from now and buy an option that is January 15th, 2027, you're going to see that price is going to jump up here. And it went, and there's only certain numbers that you could buy them at. So in this case, it changed to the $22 price that I could buy the option at. So it's already $1.61 above that. And it's saying that there's a bigger spread because this is a very far out option, right? I'm getting 23 months of opportunity for this stock to go to the moon. If it went back to its old high of 46, this would be a great buy. So the price will change based upon the amount of time that you put into this. Let's say that we want to give it 2 weeks. You notice that this 1 week, this was, oops, hang on. Let me go back to let's keep it at the 22. So the 22 1 week is $1.88 at the midpoint where it probably would trade. In 2 weeks, it's 202. So you see that you're paying just a little bit more premium. If I went out and said I want to be a month out, I'm paying 256. See how the number gets bigger when the time value gets into the option. And there's a lot of complicated math you can do to try to figure out the values. But the easiest way, if you're trying to figure this out, is just play with the number. I could change this from 22 to a 23. 23 at $1.97, right? I'm paying less, but I'm also saying that I'm willing to pay a higher price when I buy that option. Now, when I go to buy this, once I figure out which expiration date and price I'm willing to buy it at, and for those of you looking for something cheaper, you could go back and say, listen, I want us to go to 25. And at 25, the price drops more. You can pay a lot less, but if the stock goes way up, you get a huge return on your money. The order type, it defaults to limit, which is a great default for this. And it also defaults to paying, in this case, the asking price, which is higher than you probably need to pay. Usually, if you're looking at a spread like this, you could bid right at the mid if you wanted to buy it right away, and you could do that. And I could just change this to $1.19. And at the $1.19, I probably get this trade in if the market was open and this was going on right now. And with the limit order, I have a choice of trading it for the day or trading this good till canceled. There's a limit on how long that would be because obviously the expiration date is March 21st, so it can't trade beyond that date. Besides the limit order, I could use a market order, especially with options. I don't suggest this unless you're really confident what your number is going to get filled at because you're going to get any price. Right now, you would pay at least $1.23, but you might pay more. This might come in at $1.25, $1.30, $1.35. You're just jumping in and buying whatever the next number is that somebody's put in there willing to sell that option for. So you normally wouldn't do that. The stop market order is not going to apply because you're not looking to sell. And the same thing with the stop limit. Those would only apply when you're actually looking to sell, but not when you're looking to buy to open. That means limit order, good choice when you're buying this option on Charles Schwab. And pick your price. I would aim for the midpoint or slightly below, even if you want to try to just get pulled back. Or you might have a specific target you have in mind and you say, hey, listen, I'm not paying $1.19. I only want to pay $1 and I'll make that good till canceled. And I'll let that, let's say I'm going to let that run till 2/21. I'm just going to let that run for basically whatever it is, 5 days from now, this whole week. And if it doesn't fill for $1 in that week, it will expire. If the price comes back to $1 and they can fill my order, then they would buy it. And I would pay $100 and I'd have the 25 call option, right, to buy the stock at 25. And that option would expire on March 21st. So I'm investing with the idea that the stock would go up. Once I have all this done and entered the way I think that I want, I click on review order and the screen will come up. It will review the order short. It'll say that you're buying to open. One Intel option, one contract, controls 100 shares, remember. Expires March 21st, 2025. It's a $25 strike price, so higher than the current price of the stock, but I get it for a lower price. Maybe that's a good idea in this case. The limit I'll pay is $1. It's good until canceled. In this case, I have it open until February 21st, which from the time I'm making this is a full trading week. And then you can see the estimated amount that I'm going to pay is $100, right? $1 times $100. Always verify all your numbers. There's an industry fee of 1 penny, a commission of 65 cents. the estimated amount I would pay is $100.66. And if that's good with you, then you come down here, you could click place order, or you could change your order, or you can cancel your order. If you click change, it would just go right back to that same screen. You can adjust anything you want, or clear this and start over, or just leave the page if you're done and don't want to actually make the trade. But you can go in here and play around to your heart's content. You don't have to be intimidated. You can say, oh, I wonder what the March 17th order costs. And what if I said, oh, I'd like to be more in the money and I want to buy the $20 option? I could do that, right? So you can just play with this until you click review order and click place your order. You're not locked into anything. And even then, unless the order has been completed, you can actually cancel the order. If anything isn't to your liking or you just decide you change your mind, you can cancel the order as long as it's not been filled. You can quite literally instantly go in and look at your order and cancel the order. That's not a problem at all. I hope this has been helpful to you. This has shown you how to buy a call option on Charles Schwab.